let's go ahead and give a warm welcome to this morning's guest. I'm going to go ahead and bring on Luke Lloyd. Luke, how are you doing here this morning?
Ryan, I'm doing well. Went to a wedding this weekend, though. I think it was like 100 degrees down here in Kentucky, Indiana. So it pulled everything out of me. So it took a lot to get up this morning, but I'm ready to rock and roll. So.
I absolutely love it. You're going through the heat wave, too. Not far away from me. I'm actually in the Chicago region, and it did not quite hit 100, but boy, oh boy, we got close over the weekend. Unbelievable.
And there's some investment opportunities, though, to take advantage of this. I'm sure we'll get into some of that, right?
Absolutely, we will. So this is Luke Lloyd, CEO of Lloyd Financial Group. I just got to say here, I like memes. I like popular culture. I love that your firm's abbreviation is LFG. I absolutely.
I hate to say it. I don't want to come across that this is the only reason I picked Lloyd Financial Group, but it definitely was part of the consideration. I'm like, I have to go with this.
Yeah, no, I absolutely love it. I can appreciate that. So first, this is your first time joining us here. Can you go ahead and tell everyone what it is that you do and what they can expect from LFG?
Yeah. So LFG, obviously the acronym itself means that, I'm young and bold, and, my whole entire life has been learning from people smarter than I am. And I took a big risk here about 4 months ago, started my own firm. And the biggest thing I want people to know about me is I'm not afraid to speak my mind. I'm not afraid to tell it how it is. And frankly, I think that's really needed in this world where everyone's in this industry very kind of, chest out, monotone, kind of just, plays in the middle of the road. Mm-hmm. At the end of the day, look, I'm not going to be right all the time, but you'll for sure know everything's going through my head unfiltered, right? And, obviously the financial planning, tax planning stuff comes into it, but the investment side, that's the fun part, right?
Yeah, and honestly, we need more of that, in my opinion. I've been saying that for a long time. We say here on this show, we make many mistakes all the time. One of our mottos here is it's okay to be wrong, but it's not okay to stay wrong. So
that's exactly right. It's all risk management, right?
That's right. I'm with you on all of that. Okay, well, we've got a pretty unique scenario going on right now in the markets with everything from geopolitical conflicts to tariffs. How are you navigating this current landscape? What do you like, sector-wise, individual name? Go off.
I mean, it seems like the volatility, and I'm not talking about the volatility in the markets. I'm talking more about the volatility from the top, right? We don't, every week there's so many new things to think about, right? So at the end of the day, I think you have to consider where we've been and where we're going. And, I've been very outspoken that, that we live in this debt Ponzi scheme. We live in this world where it lives on government debt, it lives on corporate debt, it lives on personal consumption debt, whether it's credit cards, loans, mortgages, right? So you can cite back to 1971, getting off the gold standard, kind of allowing the government to print tons of money. You can cite 2008, 2009 bailouts with the Great Recession. You can cite the COVID era when we printed trillions of dollars. But what's interesting when it comes to the Federal Reserve that was created in 1913, it's great at two things. It's great at bailing things out, and it's great at breaking things. And we've only landed the plane softly one other time in regards to the Federal Reserve hiking interest rates, and that was in the 1993 era with Greenspan. And then if you look in the 80s, you could cite some of that with coming out of the double dip recession in the early 80s. In the mid 80s, coming out with somewhat of a soft landing, but I don't count that because of the double dip. My point is with that, though, is we're going through the breaking cycle when it comes to the Federal Reserve. So they were late to the game hiking rates because when you print trillions of dollars, even the top economists of the world can't say that we're going to have inflationary issues, which is crazy to me because we were calling it, slamming my hands on the table for that. But now they're late to the game cutting rates, right? So I think what you're going to see is a quick move to where we have to adjust to a slowing demand in the economy, and you have to adjust to maybe some of these other geopolitical events going on. But when you have a Federal Reserve now that's going to be cutting rates, and I think they're getting late to the game, so it's going to be quick and pretty explosive when it does happen. And what I think is going to happen is there's longer duration treasuries, there's longer duration stocks, maybe even small cap companies that have a lot more leverage on their balance sheets. All of that kind of stuff is going to catch up. So long duration bonds like TLT or long duration stocks, like every kind of dividend payers, utilities become very sexy in a lot of ways because you have AI demand, you have the call option on yields going lower, which is going to benefit utilities there. And then you have the heat demand going on, which is going to increase the, obviously utilities that we need here. So you have all that stuff going on for utilities, but long duration stocks, long duration treasuries, small cap companies, I think all of those are different sectors and areas you need to pay attention to, because the tech stocks are actually like banks now at this point, like the big tech stocks, right? Like the Apples, Amazons, and Googles with hundreds of billions of dollars of cash. I mean, with the higher interest rates, they're actually making like billions of dollars just on their interest on their cash, right? So lower interest rates, what you're going to see is a lot of those big tech companies go in and try to acquire their small companies. So you get a call option on yields going lower, which will allow these small companies to refinance their debt and actually benefit them. But you also have the call option on probably these big tech companies coming in and scooping up every small company they can.
Okay, so that's awesome. You gave us a ton there. Let's first start here with the TLT. It definitely sounds like you're bullish on TLT. Yeah. Do you have a particular trade here that you want to talk about on how you can actually capture some gains using TLT?
Yeah, I mean, I think we take a look back throughout the past year or so. TLT's hit all it is, for those that you don't know, TLT tracks long duration treasuries. I think the average duration in there is like 23, 24 years. So obviously, the longer duration you go in a bond, the more susceptible it is to interest rate changes. So it's definitely one of the most risky when it comes to trying to play this yield play, because if yields in 30-year treasury notes go to 6% from the 5% they're currently at, obviously that would not be good. But why I think that they're not going to 6%, why I think they're probably going to 3.5%, maybe even 4% over the next year, is because of the debt Ponzi scheme that's going on, and also because of a flight to safety here in the United States that I think is on the horizon. Whether it's bad economic data, whether it's more heated geopolitical events. I mean, we tend to forget that Taiwan is something that China's probably still planning on taking a move on. Obviously, Russia-Ukraine situation is going on. Middle East, I don't think is long-term figured out, and frankly, I think the United States getting involved in Iran actually ticks off China pretty much pretty well. I mean, because their relationship. I think Iran's already ordering like jets from China at this point. So my point is, the China-U.S. negotiations that we saw, the March and April sell-off of 20%, I think that could be happening possibly again maybe in the next year or so. So when it comes to the yields on the duration on the treasuries, if we get a 1% move on the downside, whether it's risk-off trade or whether it's the Federal Reserve cutting rates a lot, even though they might not have full control of rates, I think the free market has more control. If you get any of those different scenarios, I think you'll get that 4% 30-year treasury note, and that could be a 30 or 40% gain on TLT. If you want to do, and I shouldn't be saying this because I don't really talk too much about the actual day trading or swing trading on shorter term time horizons, but I'm more than happy to talk about it. So I think your viewers care more about in and out stuff. You can definitely buy some leaps. I mean, I again, don't take this as direct financial advice, but I'd be looking maybe at like a year out on the strike of 100 on the TLT. I don't exactly know what the premium's going for, but you could probably make some money there as well if you want to leverage it a little bit more.
Okay, that's awesome. One of the things when we first started talking about the TLT being a potential trade, I think it was at the end of March, beginning of April, right around all of the tariff stuff. One of the notions here was, if you think that the TLT is actually going to end up trading up, if you're bullish on TLT, you might actually want to just kind of buy some of it, hold it, and then maybe sell some covered calls against it. One of the things that we saw here on the TLT is it really struggled to break the 200-day moving average, which is the dark blue line that I have on my chart. It looks like it's still actually using that as resistance. So in your scenario here, targeting leaps there for 100, that makes a lot of sense. We actually have a pretty good resistance zone identified right up there at that $100 level. I like that too. So
see, I love bringing this back into the equation. I come from a very mathematical background, so I was doing a lot of research on Fibonacci sequences applied to the markets in a lot of ways. So technicals is actually how I got my start trading stocks. So I'm more let's rock and roll with the charts. I like that. If we get above the supply zone of the $100 level, like obviously the 200 days the first one to get above. If we get to the 100, expect maybe a quick, some sell off there, some supply there. It's probably going to drive down the price a little bit, but I think long term, there's no possible scenario that the economy can function at these higher interest rates, whether it's again personal debt, the government debt actually is the most important thing. Government debt needs to refinance. 50% of the government debt here in the U.S. needs to refinance over the next couple of years, and then our interest payments on our debt is already higher than our defense spending, and typically in history that's not a good thing as a nation. So even the government needs to refinance their debt at lower interest rates. And that's why, even Trump's being very outspoken. He hates Powell. He wants to get someone in there to lower interest rates. And Scott Bessent's direct job in the administration is to get the 10-year Treasury note back down to 3.5% or so as well. So I think everything's pointing to a downside move in yields. That's how the economy works. And if we don't get that, the whole economy implodes. And that's not good, obviously.
I'm with you on that 100%. Okay. One of the other things that you mentioned in there were small caps. I do want to ask you about defense stocks because we talked a little bit about that. Maybe there's something you like there as well. But you were mentioning some small cap stocks there. And I love the idea of some small cap company either coming up with a new product or a new piece of technology that looks game changing. And now that company becomes a potential takeover target, excuse me. I love waking up and seeing companies that I'm holding trading at a 40% premium because another company wanted to come in and buy them. It's awesome. Is there anything that's really kind of catching your eye right now, whether it's theme or individual name related that you're looking at?
Yeah, so let's talk about a small company, Aspen Aerogels. I think ASPN ticker. Very interesting stuff. It's not just an EV play, but it's kind of a play on the overall battery technology and technology in general of the output of energy. They have a very unique technology around the gel that goes around the batteries and all these kind of machinery parts. And that gel essentially makes these batteries more efficient, and it makes them produce more efficiency, more output of the energy itself. So it also retains the energy too. So this company sold off a lot. I think it was trading at about 20, $30 as you look at the chart, late 2024. It's down to like $6. Yeah, $5.97 it looks like on the screen. So, this is a stock, I think it's down to $400 million, $500 million market cap roughly. The earnings going forward, that keeps on growing its top line revenue. The problem is they have a little bit of debt out there. They spend a lot of money to grow. So that's why the stock has been kind of unloved with this higher interest rate environment. But I think they're a huge acquisition target for like maybe the Teslas of the world or the EV sector, any kind of even car company that wants to kind of get involved in a direct play on having an edge on their own battery technology. So it could be a takeout target. If it's not a takeout target, I think it's going to get its kind of debt issues and non-profitability under control. And this stock should be a $15, $20 stock probably down the road.
Okay, amazing. And actually looking at the chart here, doing a really good job basing around this $5 handle, it looks like since March. Got a great volume point of control down there going all the way back to the middle of last year. So, okay, great stuff there. ASPN on your radar. I do have a quick question here from one of the viewers. Hopefully you can take this one. Ryan, ask for Luke's thoughts on energy and AI energy demand. Any thoughts on that you want to share with the group?
Yeah. So this is going to stick around. I mean, AI is revolutionary in every single way. And frankly, the one thing that ticks me off about the Federal Reserve is their comments around AI not replacing jobs. So it's very interesting. We could talk about, that's one thing I didn't even mention, is AI in itself is disinflationary and deflationary as well, as it takes jobs and it will take jobs. There's these boomers out there, not to talk, my clients are usually boomers or Gen X, but, a lot of people don't understand, I don't think, the impact that AI is going to have. It's not going to create as many new jobs as it is, the jobs it's going to take away. So I think it's disinflationary. It fits the theme of TLT that we were just talking about that happens throughout the economy. But when it comes to the actually energy demand, I mean, I use AI every single day for my business. It probably saves me $200,000 of paying someone else to do some things for me, whether it's clipping videos or things like that. Every corporation is going to be using it. Every person is going to be using it. I mean, every college kid is already using AI. So my point is, you have this huge build out. Demand is not going to falter at all, probably for the next 5 to 10 years. There's so much underinvestment in the infrastructure around AI, whether it's the utilities or the data center REITs that you can kind of cite for that. So that's not going away anytime soon. I think actually demand is like 8 times higher than the current actual infrastructure that it could support. So we actually have to catch up like 8 times over that limit. So you can play this again through the utility companies. You can play this through energy, natural gas, because 50% of the U.S. energy supply, and again, I'm just citing U.S., obviously it's more across the board around the world, but 50% of U.S. energy supply is still supplied by natural gas. So playing stocks like LNG, which is Cheniere Energy, or playing another stock that my clients own, XEL, that's more of a kind of renewable and diversified play around energy. These kind of stocks, I think, are going to continue to do well. But honestly, XLU you can track with the utility index. I think that also is a really good play. It's like near all-time highs, kind of like every other thing in the market kind of is. But utilities, I think, are still really, really sexy going forward with the AI demand, with lower interest rates, and the heat waves that continue to go on. I mean, again, I'm not going to be the one saying it's climate change. I'm not going to say the thing going whatever it be, but there definitely seems to be more extreme weather going across the board, whether it's higher heat or during the summers or colder during the winters in some ways. So that's going to actually impact these commodity prices, which is inherently going to help the energy companies and utility companies.
Okay, real good stuff there. Jonathan, I hope that answers your question. Appreciate you taking that question there. I do want to give you an opportunity. We talked a little bit about this before. How about defense stocks? Is there a defense play that you like? I understand that this theme makes a lot of sense, especially what's going on right now. This show, our group here, we've talked a lot about drones. We've talked a lot about the conflict in the Middle East and maybe how to trade that. What say you? What do you like here?
Yeah, so I personally, my clients own Lockheed Martin. I mean, you can play the Raytheons, you can play Palantir as more of a tech play around defense and AI and cybersecurity and stuff. But I think direct playing Lockheed Martin, the reason being that one instead of the others, it's got a little bit cleaner balance sheet, less debt. They bring in more revenue to produce more profitability per dollar revenue they bring on compared to something like Raytheon. So, and the best thing from a macro side about the defense kind of area is obviously defense spending in the U.S. is not going away anytime soon. But people don't realize that defense spending in other countries is actually relatively low, especially from a dollar amount and percentage amount compared to the GDP. And one of the things that other countries are starting to realize, if you look at, whether it's the data that's coming out or whether it's actually the current administration pushing for this, they've been outspoken about this as well, whether it happens or not directly from them, I think it's going to happen just because of the trends of, nations wanting to now protect their citizens because of all these heated geopolitical events in all these different areas around the world. I think the current average that countries are spending compared to the defense spending on their GDP is like 3 to 5%. I think people, a lot of countries are realizing they need to spend maybe closer to 5 to 10% of their overall GDP on defense spending. So if an aggregate outside of just America, if other countries are increasing their defense spending, that's going to these defense contractors. And I'm going to stick with kind of the stock and the company itself that has the better balance sheet, that has the F-35s that we kind of are all watching Facebook videos on every day. It seems like now, at least I am. Maybe the algorithm just shows me military videos. I don't know, but they have the F-35.
I'm guilty, Luke. Same thing happens to me. I absolutely love airplanes. I love military history. I get fed that stuff by the algorithm all the time. So I totally get it. As far as Lockheed Martin goes here, we do have a trend line here that we're trying to break over. We have the 200-day shortly above that. I suspect these might converge by the time we end up taking that out. We're down.
Yeah, hopefully it looks like it might be forming a death cross. I think that's what it is, but maybe a golden cross would be good here.
Yeah, well, so here's the thing. So my 50-day is this bright yellow line. My 200-day is the dark blue line.
All right. So we haven't crossed over or anything yet. We're maybe get the golden cross if we get a rip higher, right?
I was going to say, if we get a rip higher, we take this trend line out. We're going to be talking about a potential golden cross here on LMT. So, okay, Luke, this has been absolutely awesome. We really thank you for all of the time that you've given us here this morning. I, for one, look forward to having you back whenever we can. Was there anything you wanted to finish off here before we set you off for the day?
Real quick. I really wanted to talk international countries. I think it's very interesting. The DXY dollar index is down a lot the past 4 years. It's at the lowest it's been in like 4 years. So if the US dollar is declining, which I think it will continue to decline with lower interest rates, you usually get a stronger dollar when you have higher interest rates. So the fact it's selling off with higher interest rates is very interesting. But South Korea, that's one you pulled up. That's obviously one you had on my list. I think that's very interesting because we wish here in America we were at in their country when it comes to the economic data standpoint. Inflation's down to 1.9%. They're cutting rates. They're printing stimulus packages. They're basically doing what Reagan did in the 80s by lowering rates and printing money essentially and giving stimulus out to the current economy, kind of like we did during COVID in a lot of ways. So the corporations should benefit from that. Their companies should benefit from that. I think South Korea is a great spot. I think South Africa is a really interesting spot. India is a really interesting spot. Mexico and Argentina all are ones that my company are looking at. I don't know. We don't have enough time to dig into each one of those, but South Korea would be the top of my list right now, just because of the unplugging from China as well as the economic data I just cited. But those are all 4 other countries I would take a look at for your viewers.
Okay, that sounds awesome. Sounds like we need to have you back and pretty soon. Before we go here, where can people find more of you? Where can they read about you, read about LFG? Go ahead and plug it.
The biggest thing that I've had a lot of fun doing is this newsletter, which is going to be coming out every 9 a.m. Monday through Friday, but it comes out in 14 minutes from now. But I would go ahead subscribe to my newsletter. It's Lloyd. It's LloydFinancialGroup.substack.com. That's one way you can get in my mind every single day, Monday through Friday. And then I do lunch with Luke's, where I go over the newsletter every noon to like 12 to 12:30 Eastern time on Twitter, Instagram, Facebook, and LinkedIn. in. So most people that care about investments follow me on Twitter. I'm a little more active on Twitter and LinkedIn probably than everything else. But Lloyd Boy Luke is my handle on Twitter. It's 2 L's, Lloyd Boy Luke.
Okay, Lloyd Boy Luke on Twitter, and that's lloydfinancialgroup.substack.com. Did I get that right?
Correct. Yeah,
Okay,
and you can find that on my website as well, lloydfg.com.
Perfect. All right. Luke, thanks so much. Really appreciate it. Great stuff here this morning. Again, we really thank you for the time and look forward to having you back soon, okay?
Always fun. Thanks, bro. Thanks,
Yep.
guys, for viewing and watching. I appreciate the commentary on the sides of this. This is cool.
I'm telling you, man, we've got one of the best groups of active traders and investors around. Look forward to having you back. We're going to keep raising the tide for everybody.
Thanks,
Take care of yourself.